If I were to look at my calendar and you look at yours, next Friday is going to be the month of December. That means November is going to be behind us. But before November leaves, we have another key event next week that's going to grab the market's interest. So let's take a look at what's on schedule. Friday is indeed December 2nd, and on that day we're going to have the U.S. jobs report. The expectations are that the non-farm payroll increases by 200,000. That was 261,000 last month, if you recall. And recall, we had a higher revision to the prior month of about 50,000. So it was a solid 300,000. But if you look at the moving averages of the 3-month moving average of the non-farm payroll, it has been trending down. It's around 289 coming into this week, but it was well above 600,000 at one point this year. So it's coming down quite a bit, but still it's fairly strong, and we haven't seen a real big move in the things like the unemployment rate or like a negative number in the non-farm payroll. The market's still going to be looking at the jobs data with interest to see if there is any sort of cracks in the armor, as we've seen also some increases in job layoffs, especially with the high-tech firms. So that jobs report is going to be on Friday. In addition to the non-farm payroll, the unemployment rate is expected to remain unchanged at 3.7%. Average hourly earnings is supposed to increase by 0.3%. Those are going to be the key releases within that report. So we'll be prepared for that from a technical perspective as the week goes on. In addition to the employment report, we have one more key event that's going to take place in the U.S., and that is going to become on Wednesday when the Fed Chair Powell speaks at the Brookings Institute on Wednesday afternoon. And the market's going to be certainly interested in what he has to say post the FOMC rate decision last month, post the FOMC meeting minutes that was released this week, which pretty much showed what we expected. That was that the Fed, the pace of hikes was going to slow down, meaning that instead of 75 basis points, we're probably going to get 50 basis points in December. But we don't know what the terminal rate is going to be or what the Fed chair is thinking about what the terminal rate or that dot plot that's going to show up on December 14th when the FOMC meets and decides their next interest rate decision and last interest rate decision for the year. So that's going to be of interest on Wednesday when the Fed chair speaks. This month, of course, is a holiday month, and so the last week of trading, we have very few economic releases. So everything's going to be piled into the first few weeks, and within those weeks, we not only have the Fed decision, but we also have the Reserve Bank of Australia interest rate decision. That's going to take place not this week, but the following week. The same week, we have the Bank of Canada interest rate decision. On the December 14th, we have the FOMC rate decision. That's Wednesday. And on December 15th, we're going to have the Swiss National Bank. We're going to have the ECB and the UK all announcing their rate decisions on that day. So, and that will pretty much end the month from key release data. I forgot to mention that on the 13th, right before the Fed decision, we are going to have the CPI data come out, which is going to be another key release for the Fed. They still get to see one jobs report and another CPI report before they make the decision as far as how much they want to raise rates on December 14th. So that's a fundamental picture. That's what we have to look forward to going forward in the next few weeks and during next week's trading with the jobs report and the Fed chair speaking. So with that said, let's take a look at some of the technicals and what are they saying to us from a bias directive, from a risk focus directive. And I'm going to start off by taking a look at the euro versus US dollar. So sit tight. Hello, it's me again, Greg Michalowski from Forexlive.com. I'm going to take a look now at the technicals that are driving the market during this segment. I tend to look a little bit longer term and shorter term to see what kind of clues we're getting from the market charts and spend a little bit more time than usual and also go through all the major currency pairs versus the US dollar. So there's a lot to go through. So let's see what it looks like. We'll start off by taking a look at the euro versus US dollar. And on the daily chart, what we've seen in the month of November is a couple of tries above the key 200-day moving average. That's the green line in this chart. And toward the middle of the month, we moved above it on two separate occasions. And you can see we didn't close above that level. The market started to rotate to the downside. And in trading this week, after bottoming on Monday's trade, the market started to rebound. We had 3 straight days to the upside. And today's day was somewhat unchanged here in the euro versus US dollar. Maybe we closed a little bit to the upside as we head into the new trading week, but we are also closing above the 200-day moving average. Once again, that level comes in at 103.875, and we have to keep that level as a level a barometer for either bullish or bearish going forward. If the price is able to stay above that level, that's more bullish. If the price moves below it, that would be more bearish, and we just have to deal with it. We have to deal with this ups and downs. The market is just trying to figure out which way it wants to go. Now, what I like about this daily chart is what happened right here. Right here in trading here on Friday, the market came down to this swing area, this yellow area through here. And what it defined that swing area? Well, if we go back to these days right here, this is nothing new for some people who have been listening to my analysis. We go back to the month of May, June, and the beginning of July, and we had a low, all come in in this area between the 103.48 and 103.65 level. Not only that, but when we came back and retraced back up to this area, what do? We found 2 days where sellers came in that same area and push the price to the downside. So key level, admittedly in the month of November, we've seen the price waffle above and below that level. I'm going to make the excuse that the market wanted to go and test the 200-day moving average and also test this 50% retracement level at the 1.0515. We were able to get above the 200-day moving average, but not get to the 50% retracement. So still potentially work to do on the top side for this currency pair if it's going to continue to go to the upside. But holding above this swing area was left a more bullish bias going into the new trading week. If we were able to stay above that level in the short term, stay above the 200-day moving average, that would be the best case scenario. And then we're going to look toward the 50% retracement. That level comes right here at around the 105.15 level. The price that is of the trading range. This is a high of 2022. This is low of 2022. So a key level, I like to think of it as a seesaw. The apex of the seesaw here, where on one side it's more bearish, and when you switch over the other side, it's more bullish, and that's what we're going to be looking for in trading next week. Can the euro versus US dollar continue its run to the upside here, get above the 50% retracement, and force its way up to the next swing area, which comes in right here in this area through here, where again we have a number of different swing lows and swing highs all through this period right through here, where before the market moved away from that area. That area comes between the 1.0615 and 1.06347. So 50% retracement, that level, and this swing area on the top side would be the major targets on further upside momentum in the euro versus US dollar. If we fail again and we go back below the 103.48 level, then we look back again toward the 38.2% retracement in this swing area. This swing area has a number of swing highs through here, on the move to the upside where we retested this level. We came back below it and used that level as resistance here. And in trading 2 weeks ago, the market found support against this before moving higher. It was sort of like this level right here, but down a little lower. In trading on Monday this week, the market did move below that level, but we couldn't get to the next target down here near the 1.0197 level, and that gave the buyers the go-ahead. Once we move back above this swing area, back above this area, was more bullish bias here for this currency pair. So this 38.2% retracement in the swing area is going to be a level to get to and through, followed by the 101.97. I would think that after a number of times above this 200-day moving average, if we do fail again, that we're going to see a little bit more of a downward bias in trading next week, maybe even down toward the 100-day moving average. We will see, but all depends upon what goes on here at the 200-day moving average and whether we can get above the 50% retracement in the euro versus US dollar. So that's a look at the that currency pair. Let's take a look at the dollar versus yen, and I'm going to start off by taking a look at the daily chart here. The daily chart. Last week, if at this time we had moved the price below the 100-day moving average, and the price tried like heck to stay below that level at the end of last week and into this week. But then on Monday, the price moved above that 100-day moving average, and all bets were off as far as the selling potential for this currency pair, as long as the price was able to stay above that 100-day moving average. As you can see, it wasn't able to do that on Wednesday. we started to see some dollar selling, big move to the downside. On Thursday, we saw some follow through. On Friday, we had an up and down trading session inside day. It looks like here for the euro dollar versus yen. What do we know about the bias here? Well, we are below the 100-day moving average. The buyers had their shot above the 100-day moving average. So dollar sellers still are trying to hold on to the control and push this pair to the downside. Now, what we also know is the 38.2% retracement of the 2022 trading range. That's this low right here, this high right here, still hasn't been broken. We came down toward it right here, but found support buyers early against that level, forcing the price to the upside. Now we're almost done with the up and down lap here with the 38.2% retrace and looming on the downside at 137.24. If the price is able to get below that level and stay below that level, we're going to have the 200-day moving average in the dollar versus yen as the next key target to get to and through. That comes in at 133.95. That's three big figures plus about another 30 pips to the downside. So it's a pretty big way to the downside here. But just imagine in your mind, we do have the Fed Chair, and we also have the unemployment report coming out. If they come out more dovish, or if the employment report comes out weaker than expectations, we get that move to the downside. You never know. You never know. So we have to pay attention to this 38.2% retracement, and then look at the 200-day on the downside. Let's take a look at the hourly chart, because there's some clues here in the hourly chart that might give us some early ideas as far as which way this currency pair is going. And if we look at the 100 and 200 hour moving average, what are they doing? They're converging, okay? They're near each other, and that's because we've been in this up and down trading range over the last few weeks of trading. Move to the downside, move to the upside, move to the downside. Then we're trying to move to the upside here on Friday, and see if we can maintain that momentum to the upside. In this yellow area through here, we have a number of different swing lows, swing lows, swing lows. Got a little messy in trading this week on Thursday. It was Thanksgiving after all. And then we tried to hold resistance here in trading hold resistance on Friday, moved down to the downside here, but then rotated back to the upside. The thing that we did do on Friday was we did hold this level right here. And what's the significance of it? Well, if you look back to this day right here, we had swing low, swing low, swing low, swing low. We had a swing low here and then broke to the downside and used that level as a swing high right through here before moving to the downside. So I'm going to put that line back in there just so you can see the price action above and below. It's more bullish above, it's more bearish below. We came up to that level on Friday and we found sellers against that level. So the sellers are trying to keep the lid on the dollar there. Dollar yen ahead of both the 100 and 200 hour moving average, and here's our 100-day moving average. So the in the short term, very short term here for the dollar versus yen, get above the 139.61 level, get above the 100 and 200 hour moving averages at 140.89, and then we'll look toward the 100-day moving average. Those will be our targets on the top side here. You might even include this area right through here, which was a nice little ceiling through here as a level to get to and through. So the hourly chart is really showing you a lot of the roadmap for this currency pair. We'll see how all that plays out in the new trading week. Now let's take a look at the sterling versus US dollar. Again, we'll start by taking a look at the daily chart. And on the daily chart, what do you like about this chart, Greg? Well, if we look at the high price, this is the high price from 2022, and this is the low price from 2022, all the way down to 103.53. The high price was way up at 137. So a huge trading range this year, 3,400 pips to the downside before the market started to rebound. Of course, this was the Truss debacle, Prime Minister Truss debacle. So if you really think about it, maybe it was, the low should have been somewhere around the 114 level as opposed to way down here. But we had to work our way through that debacle and get our way back to this level. So getting to the 50% retracement of this move to the downside would on a normal non governmental mess up, this might have been the 38.2% retracement we're looking at rather than the 50%. Nevertheless, so that made it sort of a level that I felt like we could get to and through, and indeed we did. And in trading here on Wednesday, we moved above it, and Thursday we stayed above it for the most part. And on Friday, again, we stayed above it for the most part. So the 50% retracement comes in at 1.20499. Keep that level in mind. It's going to be a close support level in new trading this week. Now, the problem with this level is that just above it, we have this 200-day moving average. And if we go all the way back to this point right here, this was the high for the year. What was the price doing at that time? It was testing the 200-day moving average. So through this entire year, the price has been below the 200-day moving average. That's somewhat significant. So if we do break above that level, it's going to be a key level. The last time the price was above the 200-day moving average, you have to go all the way back to this day right here, which goes back to September 15th of 2021. So a long time coming that the price hasn't been above the 200-day moving average. So be aware of that key level. Get above that level, it's more bullish. Watch 50%, it's more bearish. So that's sort of how we're going to play the sterling versus US dollar in the short term for that currency pair. Let's take a look at the hourly chart, see if there's any clues that are of significance in this chart. And what we see here is we had this move to the upside, this trend move to the upside. This is the last time the price was below the 100 or moved below the 100-hour moving average, started this trend move to the upside. Indeed, the price came down. You can't see it, but the 38.2% retracement is right where the price bottomed out right through here. Can't see it because the 100 of this move to the upside is covering it up. But that was a significant, and we did find resistance up here that put a lid on the pair. So the market was trying to figure out what it wants to do in this range right here. Well, it decided what it wanted to do on Wednesday when the price broke above that area, and we started to see increased momentum, as you can see, to the upside here. And that took the price all the way up to the 121.52 level, above that 120.49.5 level. And we got close to the 200-day moving average, as you can see right here, but found early sellers, and we sort of waffled our way to the downside in trading here on trading on Friday. Now, what is here's that 120.49 level. As you can see, the 49.9 level, that's 50% of the year. You can see how close the price got to that level. So that's going to be a key level going forward. Also in play here is the old high from November 15th, which came in at 120.27. So I would be inclined to say that this level and this level is going to be our key barometer to start off the trading week. The 100-hour moving average is moving higher as well. So you can imagine that it might get up toward this level right here, in which case if the market should move below not only this high right here, move below the 120.49.9 level, but also move below the 100-hour moving average, that would be a trifecta that would cause the price to move further to the downside with the 200-hour moving average. Swing area is another key target level, 61.8, and maybe even move down back toward our 100-bar moving average on more of a bearish move here in the sterling versus US dollar. Absent that, stay above this the 100-bar moving average, stay above the 38.2, stay above this high, stay above this high, the 120.49 level, and guess what? The buyers are in control, and we start to look at the daily chart for those levels on the top side, including the 200-day moving average. So that's the sterling versus US dollar. Let's take a look at the dollar versus Swiss franc next. And remember last week I talked about the ups and downs and ups and downs and ups and downs on the daily chart in the dollar versus Swiss. And indeed, on a mini version, we saw a move to the upside and a move to the downside in the shorter term here. So the up and down bias continues just in a mini range here off the daily chart. I guess what you can say is that the try above this broken trend line here failed. The market moved back below that level, and we came back and tested the underside of that level right here and found willing sellers. It's near the 61.8, 0.9494. Nice symmetrical number, if you will. So stay below that level is more bearish. On the downside, we have these off the daily chart. We have this swing area through here. Let me put it on the arrow here because it makes it easier for me. Swing levels all through here. Swing highs, swing highs, swing highs. Break above, don't return to it until this point right here where we found support buyers. And again, in trading this month, we found support buyers in this yellow area as well, and including this week where the market came down toward that level and found early buyers against that level. So get below the 0.9353 and get below the 0.938882 level would be more bearish for the dollar versus Swiss. In the new trading week, that would be more bearish for the US dollar. On the top side, if we get above 94.94, I start to look toward this area right here, and then start to look toward the 200-day moving average up here in the 50% retracement of the year's trading range, which comes in at 0.9619. It's near the 100-day moving average. Let's take a look at the dollar versus Canada next. And if we look at this on the daily chart in the beginning of November, mid-November, the price came down to the 100-day moving average, tested a number of different bars right here. You can see that very clearly. And then the price moved higher in trading last week, and then rotated back to the downside. This swing area through here is of significance from a technical perspective. We had a swing low right here, swing low right here, moved below the level, tried to keep a lid on it through here, and found sellers against that level. So, it's okay. 133.89 to 134.19, get above that level. In the new trading week, would be more bullish for the dollar versus Canada. Let's take a look at the hourly chart and see what that is telling us. And we can see the sort of the ups and downs that we saw in trading here this week. We did make a new high. That high came into a resistance area through here. Watch that yellow area. If you go back in time, this yellow area also goes back through here to October. So it's somewhat significant, more so in the back end than it is through here, where the market waffled above and below the level. Level is dealing with the 100-hour moving average through here during that point. But we did reestablish resistance against that area right through here. The market sold off in trading this week. We are trading right near the 100 and 200-hour moving averages, which are near converged. The 50% retracement of the last move to the upside is also near this level. The 200-hour moving average of 133.59. We'll watch that level on the downside. Break below it is more bearish. Stay above it, and we could see the rotation further to the upside for the dollar versus Canada. So watch the moving averages as our barometer in that currency pair. The Aussie versus US dollar on the daily chart. This is the high for the year. This is low for the year. The high didn't happen in January. This, like the other currency pairs, happened in the month of April, but a pretty decent move to the downside here when we broke below the 100 and 200-day moving averages. Apart from this little day right here, the price stayed below the 200-day moving average, and any sort of move above the 100 was short-lived until the month of November, where we had about 3 or 4 days above that level, and again moved back above it in trading here this week after failing above that level. So second try here in the month of November. This period right here, we had 2 days above it and failed. This period, 2 days above it on a closed basis. We closed below it here. And now we have 1, 2, 3 days above it in the second time here. So the buyers are making a play, trying to get above the 38.2% retracement as well. In the new trading week, we're going to be watching the 100-day moving as our key barometer. Maybe down to, might include down to this level here, as well as support. So we'll be watching those levels on the downside for bias defining levels for the Aussie versus US dollar. Move below it, it's more bearish. Stay above it, it's more bullish. On the top side, we have this swing area through here where we have a number of different swing lows, especially during the month of May and June through here. In the month of July, we fell below that level, and but then reestablished support here and moved higher. And then in the month of August, the market again found support against us in this area and tried to hold it, and then move below it here. It got a little messy through here, but the market reestablishes the short. So this area right here is going to be a barometer for bullish and bearish, along with the 50% retracement and the 200-day moving average on the top side for the Aussie versus US dollar. Let's take a look at the hourly chart for that currency pair to see what it is telling us. And from similar to some of the other currency pairs like the dollar Canada, ups and downs, and I think the dollar Swiss, we saw ups and downs. We're seeing the price move above the 100 and 200 hour moving average, and those two moving averages are starting to converge, indicative of a market that doesn't know which way it wants to go. But we are closing the week with a more bullish bias here for the pair above those two moving averages. If we move below the moving averages and then move below the 100-day moving average, you can see it would increase the bearish bias for the Aussie versus US dollar and send the price likely more to the downside for that currency pair. Finally, let's take a look at the New Zealand versus US dollar. If we look at the daily chart here, what is significant here is that we got closer and closer to the 100-day moving average. That 100-day or 200-day moving average, the green line in the chart, that comes in at 0.62979. This is the 100-day moving average, and we've been above that level now, building our way toward the 200. So we are trading between the 200-day moving average above, 100-day moving average below. That's a market that is trying to figure out which way is the next major move. Is it going to be that way or is it going to be that way? We will see what happens. But obviously, since the October low, the price has been doing a pretty good job of trending to the upside. The Reserve Bank of New Zealand raised the rates by 75 basis points. That helped to push the price to the upside because it was more of a hawkish hike as well. So that helped to push the pair to the upside. But we still need to get above the 200-day moving average, folks. And oftentimes that can be a little sticky here. So watch this level in the new trading week. If we're able to stay below it, then we could see a rotation, and we'll be paying attention to this swing area between 0.6184 and 0.6212. If we're able to get below that level, that would open the door for further selling. Do we go back down to the 38.2? Do we go back down to the 100-day moving average? Those would be targets on the downside for this currency pair. So, a lot to be said, a lot to be learned. Those are the key levels and bias defining levels here for the major currency pairs go into the new trading week. Once again, we do have the employment report coming in on Friday, 200,000 jobs expected, 3.7 unemployment rate. On Wednesday, we have the Fed Chair speaking at the Brookings Institute. We'll sort of pay attention to what his views are as far as maybe terminal rates of interest, the dot plot going forward, what his thoughts on inflation, and so on and so forth. You never know. Maybe he'll surprise us. My name is Greg Michalowski. Good fortune with your trading. Have a great weekend. Bye-bye now.